Good morning, traders and investors. A happy Monday to you after the long weekend. We had a good Friday in the U.S. stock market. A lot of international markets are closed today. Mr. Market's Easter hangover. Stocks trading down here a little bit today. Macro definitely still very much so driving the bus. Dollar down again. Dennis has some concerns that we're no longer getting a rally in bonds when stocks are selling off. We're going to talk a little bit about that. Couple of earnings, just a couple of earnings this week. No, the earnings season is most definitely kicking off here this week. We still got to talk Netflix, folks. Netflix hasn't traded an intraday session since its report, so we are going to talk Netflix earnings today. We got Tesla tomorrow after the close. The earnings train starting this week. IBM, Chipotle, Boeing. Thursday, we get Google, Amazon, Intel. The list keeps going. We're going to talk a few ratings today. Our guest at 8:35 a.m., Jeremy Schwartz, Chief Investment Officer at WisdomTree. Folks, let's get it going on pre-market prep.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Christian Fromhertz, how is your Monday going, sir?
Not too bad. Good morning, guys. Let's see. We've got another major as we start a new week. You know, here I'm thinking that it's going to be earnings and a little bit more micro, but it is macro. Let me go through some of these moves for you really quick in the commodities, and I'll start with what energy is doing this morning. Crude down 2%, and you could probably spot a couple themes as I go through some of these. That's crude. That gas is also down about 1.8% this morning. Let's get over to copper. Copper futures this morning. They're actually up this morning, up 1.9%. I want to move over to what bonds are doing this morning. You've got another interesting move that's going on in bonds this morning as bond prices are going lower and yields are going higher. That especially is on the long end of the curve. So what we're looking at here is 30-year bond futures, which are down 1% again. So here you think flight to safety. It's not happening on the long end of the curve, more so on the short end of the curve. We'll cover that shortly. Also, Bitcoin is kind of sticking out a little bit differently this morning because that's up 2% this morning. So it's a little bit of a risk on for that, but that could just also be the currency. And that's where I want to go to next. UUP, which you're not going to see the pre-market activity in UUP, but you've got the dollar making another big move that's getting a lot of attention. Right now, the dollar I see down 1.3%. And then let's move over to Mr. Gold. Gold this morning up and making more new highs, really getting extended here. This stock is starting to, the commodities are starting to look like a parabolic move here with gold up 2.2% this morning. And then lastly, we'll just cover silver, but definitely you got some interesting moves this morning. So with silver up 1.4%, so not as much as gold. And then lastly, I like to cover what the equity futures are doing. You've got S&P futures down 1.6%. You've got NASDAQ futures. They are off pretty decently too. Now down 1.8%, right along the session lows. They were kind of hanging in there last night, but they've worsened as we've gotten closer to the open this morning. Russell futures are also down 1.4%. So that's your quick rundown. Dennis, how are you doing?
I'm doing good. Yeah, no, it's nice. It's nice to actually just get a 3-day break here. Obviously, we've been really busy, having launched the STN room. I feel like, the markets have been crazy here too. So a couple days to get rested, refreshed here for you guys was definitely needed. I know you two were traveling too, had the travel bugs going here. Maybe we'll start with Christian here. I know you had some flight delays and stuff, but, did a little bit of traveling. How was boots on the ground? How's the airports? Are they busy?
Only a 6-hour flight delay
Oh,
coming
no.
back. Nothing to worry
Yikes.
about. There's some problems in Newark. They're for whatever reason, I think they're redoing their runways, which is causing everyone to get delayed. But boots on the ground. I mentioned I was going to report back to whether the airports were, what the traffic is there, and I
Yeah.
didn't really see too much of a difference. And like, I'd like to hear Brett's
Mhm.
opinion on this too. But on both my flights, like, airport was pretty packed. I didn't get in last night till about 1:30 in the morning last night, and there were still
Woo.
planes coming in because of the delays. But that's a little bit different than what the overall traffic was. But I didn't really see any difference in terms of what I saw in
Yeah.
terms of a drop in traffic. What about you, Brent?
I thought that it was maybe like a little light at the airport, at the Detroit airport at least, but I went to Vegas and Vegas was popping. Vegas was busy, the airport was
Nice.
super busy, the casinos, the hotels and resorts were super busy. Went and checked
Hmm.
out the Sphere. That was amazing. That was like, a sold out show, bunch of people, 17, 18,000 people in there at one
Who's
time.
who's playing at the Sphere?
Dead and Co.
Oh, nice. Okay, very, very good. So
Yeah.
packed
Well,
show for
it
that.
was packed show for sure. Like awesome technology, amazing sound, amazing visuals. It was a blast. Had a good
Was
time, and
did you see Jay Powell there by any chance?
Ha.
oh
He's
yeah,
a
he
big
is a
Mets
deadhead,
fan.
isn't he?
Yeah.
Oh, I no, I didn't see him. I didn't spot him, but he probably was up there somewhere.
So Vegas still busy.
Vegas was busy.
That's
Vegas was very busy for sure.
yeah.
Yep.
Yeah,
No
and that's the
concerns
good
there.
news. The one thing I
Yeah.
will say, and I traveled obviously to Florida there, not this weekend, but the following weekend or the previous weekend. The
Hmm.
one thing I will say is the Tampa airport is packed. So domestic travel, I think, is doing very well. One eye opener for me was, flying out of Toronto International Airport to the US, it was pretty dead, the international terminal. So, I mean, I don't know what that means, but I do think that there is this, maybe hesitancy on the international travelers' part
Sure.
to be
Yeah.
traveling, So I think, domestically, it looks like flights are doing well. I'm a little bit concerned internationally, but, that's a bigger story and maybe a story, for later on in the show. But, let's take it back in the markets here because obviously we
Yeah.
have another sell off. We're going to start with this macro theme first of all. We've got another overall sell off in the markets. You come in long weekend, you're down another 60 S&P handles. I mean, technically, it's not looking great because now we're back where we were to Wednesday's low. Need to hold there. That's critical support. It's not only Wednesday's low. If you go to the previous week, there was another low there as well, too. Joel would be proud of me pointing out all these levels, but 520 on SPY is pretty big. So you want it to hold. You want this support level to hold. You want to see buyers come in. I still think, one major concern, you touched on it in the intro here, Christian, is when we were getting U.S. equity sell-offs a couple weeks ago, the TLT was rallying substantially. That typical flight to safety that we often do see in the TLT when U.S. equities are selling off. What is interesting now, and I know you had a graphic here too, Christian, if you wanted to get that in the background and show it, is that we are not seeing the flight to safety in the long end. We are seeing the flight to safety in the short end, meaning short-term treasuries are rallying, but long-term treasuries are not. That's concerning because, I've went through a lot of crises in the past, went through the financial crisis, obviously, went through the tech bubble burst, went through COVID. I can tell you, in times of stress in the equity markets, usually US treasuries are a safe haven. And, even in the financial crisis, we were seeing US treasuries get bid up substantially during times of equity market stress. So this, what I would say is not decoupling, but actually coming together of equities and US treasuries and both going down the same direction. We're talking about the TLT being down 1.28%, which is actually more down further than SPY, is definitely concerning. You got a chart up there. Maybe you can explain this, Christian.
Yeah, I mean it's kind of funny because sometimes you'll hear someone either whether it's on social media or something, and they'll say, "Hey, bonds are a great buy here." But what bonds? What what bonds are you going to buy? Is it the long end of the curve? Because people always think, I think especially retail traders, like when they hear buy bonds, they're like, oh, that's TLT. Well, TLT is the long end of the curve, and TLT is doing very different things right now when you compare that to what the short end of the curve is. So what you're looking at right now is just across the benchmarks. This is just straight maturities and U.S. bonds. Remember, the Fed only controls the overnight rate. That's the other thing that retail traders can get confused a bit, is they only control the overnight rate. You don't even see the overnight rate in here. You're starting with the 2-year bonds, and then you're going to the various different maturities all the way up to 30-year. TLT is closely resembles around like the 20-year here. But what you're seeing here is how much the yields are going up right now. So this is in basis points. So this is about 9 basis points, which is a decent move for bonds. But you go all the way down to the 2-year, and it kind of just shows you the 2 years getting bid up. So people would rather be in things like the 2-year, or even, which I don't have in this screen, but even T-bills. People, folks are very risk off right now. And yes, they're grabbing bonds, but they're grabbing the shortest maturity bonds. They don't want the longer end, because that's more risk in bonds when you go out further, just like anything else, right? So there's more risk, and there's higher risk and there's lower risk. And I think it's a very important differential, because I actually asked somebody on Twitter this weekend, they're like, yeah, I think bonds is a great trade here. I'm like, what bonds? What are you doing? 2-year, 30-year? Because it is a major difference. So let me and then I'm just going to show you, because this is looking at it in yields. So I'm just going to stop the screen here, and then I'm going to come back. Sorry, I have to do this
That's okay.
a little bit in piecemeal. So share screen, and I want window, and now I want to do chart. So here's what TLT is doing, just to kind of give you a visualization. And yeah, I mean, you go back to a couple of weeks ago, and TLT was going up, and since then, really when the tariffs were announced, people did not want to own TLT any longer. Now, there is a short-term ETF. There's a couple of them that you could look at. This is SHY. This is closely resembles like the 2-year, for example. Yeah. And you could see what's going on here. This is adjusted for dividends. You could also look at BIL, which is T-bills. But again, it really kind of gives you a sense of like what's going on in the bond, where people are putting money to work in the bond market. They are not putting money on aggregate, they're not putting money to work in the long end of the curve.
Yeah, lots to chew on here, lots to think about. And, why is this happening? And, Gabe's got a question in the chat, and it's a good one. I'm asking myself that same question there, Gabe. He was asking, now I lost the question, of course.
I'll go.
Gabe reposted.
Does weakness in the TLT suggest a lack of confidence in the U.S. government?
Yeah, I mean, and that kind of goes to what's going on with the dollar. I mean, the dollar doesn't normally do this type of movement. I mean, this has been going down now for the last few months, but I mean, here's just what the dollar, and this is not adjusted for the pre-market activity right now, but so you're down even further right now. So that's what's going on in the dollar. I mean, you used to hear a couple months ago, people were like, oh, the dollar going down is great for stocks. Well, sometimes it is, but we haven't had this type of volatility in a long, long time. And I'm even going to bring up just a weekly chart just so you can kind of get the whole pattern here of, this is becoming a kind of vicious move where it's uncertainty, and folks don't want to be right now in US dollars. They don't want to be in the long end of the curve in TLT either. So it's a great question. And yeah, I mean, when you start to see every day that bonds are moving this much, as well as the dollar moving this much, it shows you how much uncertainty is affecting. Yeah. And that goes back to right now, we're in a very macro tape versus stock specific.
So Dennis, how are you setting? Yeah, how are you setting up for this week, given this concern, this risk?
Well, I think I set up the same, and it's all about what Trump's going to say next. In the STN room, I was joking. I actually downloaded True Social, and got True Social on my platform because I'm like, I've got to get to the source. The only thing that really is going to matter is what Trump says next, and this market whether you're a tariff fan or not a tariff fan, whether you're a Trump fan or not a Trump fan, doesn't matter to the markets. I will tell you that the markets themselves are not fans of tariffs. This is now very apparent. The U.S., not only the U.S. equity markets, it's also the treasuries and it's also the U.S. dollar. So now it's going across asset classes that the markets, U.S. markets overall, not fan of tariffs, not at all. So it goes right back to if Trump backs off, says we got some deals, says, there can be lower tariffs in some cases, that's going to pop markets. We're going to see that happen multiple times this week. Oh, there's good talks over happening with Japan, or there's good talks, or we've got a deal. And the first time they strike a deal, you're going to see a rip-roaring rally in this market, just like boom, algos are going to go nuts. That's going to happen. And I don't know when, but probably sooner than later, he's going to strike a deal with somebody. The question is, what is the reaction after that? I do personally think it's going to be a rip to sell, because I think as long as this administration continues to focus on tariffs and saying this is the way, I think the U.S. equity markets are going to be a sell the rip mode, meaning I'm going to be selling rips on all of these things. So I think everything changes if, all of a sudden Navarro isn't advising Trump, or if, Navarro and Trump obviously back down on their tariff stance. But it's pretty much, Brent, it's pretty much all that matters. I mean, you're going to have individual company news coming this weekend. We're getting into earnings season, and I don't want to say that earnings don't matter. They absolutely do. But there is the cloud of tariffs over everything right now. So maybe this is a good segue into Netflix earnings, because we haven't had a show since Netflix reported. And obviously Netflix did report earnings on Thursday night. And I know it feels like ages ago, but the stock hasn't actually traded since they reported. We can jump into that report and give you those numbers. I don't know if you have them in the background, but I can get them quickly here. I didn't have it ready, but I have it ready here now. So Netflix did report 661 versus 574 and 10.54 billion versus 10.51 billion. The beat on the top, the beat on the bottom. The guidance was strong too. They're seeing Q2 703 versus 627 revenue higher as well. They kind of said everything pretty darn good. They're saying no change to 2025 guidance. So they're not worried about tariffs. And I've said this before as well. Netflix is kind of like definitely not in the tariff storm. We've argued this in the STN room. If you look at the grade 8, talking about the Mag 7 plus Netflix, really Netflix is the one stock that you would think that's not really in the, affected by tariffs nearly as much as obviously a lot of other stocks like Apple. If you're reaching saying, oh, people international got subscribed to Netflix, I think that's a reach. So I would say Netflix definitely not in the eye of the storm. Stock, pretty good earnings, had a 55-point expected move or 58-point expected move. Barely up here this morning, only up 18. And a lot of that is because we still have this cloud over the markets, this cloud of tariffs hanging over the markets. So, I mean, here's a pretty good report from one of your, major tech companies here, not really responding in the best way that you would hope. And that's the macro tape, I think, holding down a stock like Netflix.
Yeah, I mean, they even said too, I think in their commentary, that they're not seeing anything really change in terms of what they're seeing from the consumer. So I find that very interesting. But I think it's so much more about too, like whether or not this is an expensive stock. I think the PE, the PE is still expensive. I think it's a 45, or estimated PE is a 38, 40. Regardless, 30, 38, 45. That's still very rich. And I think that's the problem. But I think it's a big relationship stock too, because Dennis, do you think that this stock, if they do announce, I was listening to some of the commentary over the weekend that the U.S. is meeting with Japan and they're trying to hash out something quickly, because I think Trump does want a quick win with some of these negotiations. Sure. And what I read, I don't know if it's true, because you don't know what's true these days, but Japan was like, hey, we've got a lot to negotiate here, so we're not interested in a quick deal. We're interested in hashing this out a bit. But if, let's just say hypothetically, let's say that they do get some type of trade deal with a country, does Netflix go up or does it go down? Because it's
that's interesting,
because it's a little more tariff proof. I think the rising tide lifts all ships, because I think when you get this first deal, and I've kind of got the scenario analysis all played out in my head, I think when you get this first deal, it's going to be a really big deal for the markets. There'll be wow, and I wouldn't be surprised to see the S&P rally 200 points on the announcement of an official deal, especially if it's with Japan or a bigger trading partner. I mean, if we
Yeah.
make a deal with the Penguins, probably not going to be as big of a
Eh.
response, and that obviously is a joke. But I think it's going to depend on who we make the deal with as well. But the first win, like you said it perfectly, Trump wants a quick win. This market will want a quick win here too. They need a quick win. We need to get out of this sentiment here of oh, this tariff cloud. The market needs some hope. And right now, you look at the sentiment indicators and, it's down to hope and despair, or whatever the hell they call it, it's the greed factor is almost zero here right now. I mean, this market needs a quick win. I think it's going to get it. I think it's going to get these pops. The problem is, I just don't know if it's sustainable, because if we're still rah, tariffs go, I think the overall markets continue to leak, and I think rips continue to get sold. So, that's kind of where I'm at. I'm still in the sell the rip camp here. I do think that we're going to get a quick win here, though, and I think it's coming fairly soon.
Well, I think that's a great point, and I think it's important to kind of think through these issues too. Once they happen, you want to be on your toes. You don't want to be on, the backs of your feet. You want to be able to kind of execute a strategy, because I agree too. And just looking at just basic technicals too, where, when price, I've got the Qs chart up here, but it's very similar for S&P too, where we're below the 200-day moving average. So my strategy changes quite a bit, because, I think about, if price is above the 200-day moving average, you're in an uptrending market. If price is below the 200-day moving average, you're in a downtrending market. So what do you do with downtrending markets when they go up, right? You sell into that strength until the overall picture changes. And that's exactly what I'm thinking. That if there is some type of a bounce, you sell into the bounce until the trend changes, until we get back over the 200-day moving average. Then I'll change and adapt further. But I think it's really important to kind of come into this week, because we are going to continue to have these headlines. We can't get away from it. And, it's a macro tape. It's a headline driven market tape. We'll see what earnings provide, but I think, to your point, I think there's something that's going to happen too. But you got to have your game plan down.
I think so. I think that's the main thing that we can try to help you guys, obviously, here on Pre-Market Prep and in the STN room, is having a game plan and being ready to go. Like I've said, in the event, where we get, a significant sell-off again, where we maybe get back down to where we were before, I have a shopping list, and we did really well, buying NVIDIA down at 88, picking up some AMD lower prices. I mean, have your shopping list, in the event the stocks sell off as well. And again, these oscillations coming, from White House commentary are going to continue, and it's going to be the main thing that matters. But, we have a lot of earnings this week, so we'll get a lot more, fundamental information, starting with Tesla on Tuesday. I'm very concerned, still long Tesla in the long-term portfolio, small piece left. Obviously sold most of it up at 390. Very concerned about the Tesla numbers, and information that we're getting here over the weekend doesn't sound great either. They're talking about potentially delaying the lower cost model. There's also talking about delaying robo-taxi due to parts shortages, which is obviously directly to the supply chain. All of this is rumors at this point in time. The Tesla quarter, I believe, is going to be a disaster. I think you are going to see that brand damage that I've been talking about show up in the numbers here. So I think the numbers are going to be weak. I think the street knows they're going to be weak. The estimates have come down substantially. Registration data we got out of California last week was not great as well here. So I think the Tesla numbers are not going to be good. The question is, how much bad news is priced into the stock, and can Musk talk the stock up? Because last time they reporting the numbers weren't that great here either, but he talked up the stock. Can he talk it up again to basically, hold the stock price up, despite the numbers probably not being great? I'm going to throw it to you, Christian, just on technicals, and get your thoughts here on Tesla as well.
Yeah, so we do have comments out from Wedbush this morning. So it's Dan Ives, right, who's out this morning, and he's talking about Tesla CEO Musk facing code red situation amid U.S. government role. And what he's basically saying is that he needs to get back to being the CEO of Tesla. So I think what could cause Tesla to go up tomorrow? And I've been wondering this, because what did they? What was the commitment that Musk originally gave?
Like
120 days.
timeline? Yeah,
Yeah.
yeah, I think so. Yep.
For Doge.
So where are we in that? So it's April, right? So when did he officially start? So like in the beginning of February?
Yeah, somewhere in there.
I
So we'd be
think it's
halfway through it at least. Getting
I
close
think
to
it's
halfway
coming up
through
in
it.
May. I think it's coming up in May.
Yeah.
Okay, so that's important. Like, so that could get the stock to lift. Like, if he says I'm going to be back and such time,
That helps.
if he provides some certainty, because again, that's dealing with uncertainty because you don't know when he's going to be back, and that could, because I think all those things that you mentioned are negatives. Maybe some of them are priced in. But I also think I don't know if he could kind of pull the rabbit out of the hat like he did last time, where he got the stock to rally. So, unless I'm missing something or unless I'm not thinking of something, I think if he talks about that timeline, maybe that could
Yeah.
overcome all the negatives. From a technical standpoint, Tesla really hasn't. I'm looking at the price action over the last few weeks. It's actually been just kind of bouncing back and forth in a range. So, the recent lows right around 216, so call it 215 is the lows. Let me just go back to the daily chart because I've got a level that I've been watching here too, on the upside, which is right around 257. Further to that, I would really like to see Tesla get back above the 200-day moving average, going back to where it was at the end of March. That's where there was resistance right at the 200-day moving average. So we're kind of sitting very close to the bottom of the range. So I would watch, if it breaks 215, I would watch out to the downside. Because next I would see, and you guys might disagree, but if that really breaks, I don't see any major support until down around like 160-ish, which is far
Wow.
down. Yeah. So
25 point expected move. So that's
Okay.
where the options were pricing out on last, Thursday when they all went off the board here. Obviously not opening here this morning, but 25 points, about a 10% expected move, which is significant as well. Yeah, again, I think Christian summed it up really well. I think the quarter numbers, I think there's a lot. I think they're not going to be good, but I think there's a lot of bad news priced in. It's all a matter of the commentary. What does Musk say? I think his timelines for Doge. I think if he says we're coming back sooner than later, that could be a catalyst to pop the stock. I think if he does officially delay Robotaxi or does officially delay the cheaper model, that would be a concern. So, and that would be something that would sell off the stock. So commentary, the conference call, probably much more important for Tesla than the actual numbers here at this point in time.
And I think also just kind of previewing what we've got ahead. Tomorrow morning you're going to get a few of the defense names, which, these are the things that there's been some big separation between value stocks and growth stocks. And I've been trying to buy the dip in a little bit of these names, because I think that there is some buying the dip that's going on more so in value groups like aerospace and defense. Versus your outright tech and growth. So you've got RTX, Lockheed Martin, GE Aerospace. So GE is also reporting. All those are all coming tomorrow morning.
Tuesday. Yep.
Yeah, before the open. So I'm interested to see how that's going to work out. LMT has got Lockheed Martin's kind of been a bit of a dud in that group. So that's a name that I would be interested. Remember, they kind of had they had a good earnings report 2 earnings reports ago, and they flew to the upside, and then they started to really come in with so that was 3 earnings quarters ago, and the last 2 have disappointed a bit, and the price action is right back to where it was from last year. But I would be looking at this stock because, again, this market still likes cheap right now, and I like this group for now. Unless something changes, but I like the defense group.
So then we get into Wednesday's got Big Blue, CMG, ServiceNow. I'm going to skip over those. I know they're huge companies here, but I want to skip over to Thursday because Thursday is going to be, 2 of the Magnificent 7 with Google and Amazon both reporting. As analyst commentary today here, I believe Amazon actually caught a downgrade, if I'm not mistaken. I'm just going to look here right now.
Yeah,
yes, Raymond James.
Yeah.
downgrading Amazon. Also, Edgewater is cautious on Amazon as well. Scotiabank lowers their price target in Amazon. So analysts being a little bit cautious here. I want to get your thoughts. First, we'll start with Amazon. I'll give you my thoughts as quickly as, I've obviously got Amazon in my long-term portfolio. It's been in there for a long time. I bought it back, at $100, during, the tech bubble burst in 2021. I've also recently bought more stock at 160. I flipped out of some of that stock at 190 because I thought we could get a retest of the 160. It almost feels like that's kind of in store here for a retest, maybe sooner than later because we're 169 here right now. The stock is as cheap as it's been relative to itself maybe ever. I believe last time I looked trading around 29 times forward earnings. I've never seen Amazon under 30 times earnings before. So that's, interesting itself as well. But, there's concerns out here. There's concerns that a lot of stuff on Amazon is sold from China. This trade war may have its impacts here too. Just throw it to you here technically, Christian. What are you seeing in Amazon?
Well, it did bounce off the low point. It did bounce nicely off some support, 165. If for whatever reason it sells off, that's what I would be looking for it to hold, and I would probably be a buyer down there. That could, again, I'm kind of getting ahead of myself here, but that could create a double bottom type situation. But it's got to get down there and it's got to hold there first. But that's where I would look to be buying it. Other than that, to the upside, where it got to 2 weeks ago when we had that rally was right into some resistance right around 192. So for now, it's right in the middle of that range. And, I think if it probably gets up to 192, you probably want to fade it. And I would be a buyer down at 165. And I find it, you bring up a great point. Like Walmart, I think is more expensive and Walmart's acting so much better as well as so many of these even though Walmart isn't a discount store, but if you go through the discount stores, like Dollar Tree had a insider buy, but look at how well Walmart and it's just because I think that people are comfortable with it's more of like a recessionary stock. People usually buy Walmart when people are thinking recession. And that goes for the same thing. I mean, look at the chart in Dollar Tree. Also look at the chart. So real nice move. Speaking of 200-day moving average, nice move above the 200-day moving average for Dollar Tree. I'm liking this chart here. The two other stocks, which I find have, and I've talked about this stock a couple times before, which is BJ Wholesaler. No volatility in this stock. This stock has been in a nice uptrend. And again, it's just acting more defensive. Even Costco, which I thought was very interesting. Costco got back above its 50-day moving average on Friday. But I don't know if Amazon could do it because it just seems to be in the bucket of, more growth, even though it's cheaper. So so just to sum it up, I would be a buyer if it sells off.
Jeremy Schwartz coming on here in 2 minutes, but I just want to give a quick point here too, which I don't know if I made this point before, but I do think that Walmart and Costco's strength relative to Amazon is exactly what Christian is talking about. Not only are these viewed as more defensive, they are the two top components in the XLP. So don't discount the fact that this is probably ETF effects that hold up Walmart and Costco better than Amazon, because Amazon is not part of the consumer staples ETF and Costco and Walmart is. And I think traders still naturally just go and buy the XLP. And as they go buy the XLP, obviously the arbitrage buys the components as well of the XLP. Costco 10.1% of the XLP, Walmart 9.3%, the top two components. Number 3 is Procter & Gamble, which has held up extraordinarily well because obviously it is defensive. So I do think that it's going to be hard to get Amazon into that bucket because Amazon is not part of the XLP. So the ETF effects of buying that defensive nature is not there in Amazon, even though from a logical perspective, the Christian Fromhertz making a fantastic point. Amazon PE cheaper than Walmart and Costco. We haven't seen that very much, folks. Not especially maybe Costco, but not Walmart. We've never seen Amazon cheaper than Walmart. That's incredible to think about.
And we do have more earnings to talk about, believe it or not. We didn't even get to Google. We didn't even get to Intel. So let's save that and let's go to our guests here, folks. Jeremy Schwartz, good morning. He is Chief Investment Officer at WisdomTree. How was your long weekend, sir?
Very good. Just got the kids off of spring break, so we had a nice West Coast trip. It's good to be back, bring it back with you guys.
Did
Boots
you,
on the ground, Jeremy? We got to know how those airports are. They busy?
I thought it was decently busy. Yeah, I mean, but there's a lot of kids on spring break, so it's you have that factor going.
Let's get into some general market talk here. I mean, what are you making of the markets right now, starting this coming off of the long weekend here, Jeremy?
What you guys were just talking about, that staples versus discretionary. On one of my dashboards, you have staples being the top performing sector and discretionary being the worst. So like a 25-point spread between staples and discretionary. So very interesting, the defensive tilt. You've been waiting for people, the valuations for that big tech leaders, the Mag 7 has compressed. It's sort of one of the smallest premiums for Mag 7 because they've really sold off. It was interesting hearing your Tesla commentary. I mean, that is like the one outlier in like a different stratosphere on valuations. It's closer to like 100 PE, but it's based on all expectations of a very different future, very different from the cars, the self-driving. I actually did take my first Waymo over the weekend. It was unbelievable, the technology on these self-driving cars. But I think
talk about the Waymo. I want to stop you for a second, just go on the tangent there, because I've had friends in the Waymo. I've never been in a Waymo myself. How does it feel? Are you nervous getting into a car that doesn't have a driver? Like, is there going to be a hurdle here for people to actually get over the thought process that, oh my gosh, if something goes wrong, there's nobody to come and save me here? Thoughts, as you're riding in the back of a car with no driver.
And I had my two kids with me,
Oh my gosh, that's crazy.
So I'll say my neighbor has the Tesla, and he showed me the full self-driving the other night. And you got to have your eyes on the road, and you can't be texting. Like, it knows it's videoing you, and that was a pretty unreal experience. I went to get that. That made me actually want to get the Tesla for when it's fully self-driving. But the Waymo, the first comment from my wife was like, "This is better than the rides at Universal." It felt like magic in many ways, and you actually felt safer often. I could feel it was very, very conservative driver. We took it 4 times. We loved it, and it was great. It was it felt very, very. It was a very impressive experience, actually.
Did you put your seatbelts on?
We did have this. They make you put your seatbelts on. You get all
they do.
Flashing sounds.
Wow. Okay, Jeremy, let's take this back into the markets. I know I interrupted your point, but just, let's just talk, as we get into earnings season here. We're obviously going to kick off with Tesla tomorrow, but Google, Amazon on Thursday. We're going to get, obviously Apple, Microsoft coming sooner than later. Thoughts as we approach, earnings season with the markets, kind of trending down here again. Can good earnings bail us out, or is the tariff cloud still too strong to bring this market back up to, to where it was prior to the tariffs?
We've definitely been saying on our market strategy calls that it's going to be tough to get back to the all-time highs with some of this overhang. That even if we, because it doesn't seem at all like we're completely reversing course on tariffs. We're going to get a bunch of trade deals, and I think there's a lot of countries at the top of line, and we're debating who's going to be the first major trade deal. India, Japan are near the top of the list. But there is definitely this extra uncertainty that comes from this effect. And, what's going to happen to earnings? Earnings have been being marked down in general, but you're going to have to see where it goes. Recession probabilities have increased. The poly market was saying over 60% probability. So people are now getting more pessimistic on the outlook for the economy. Then you got to see that feed through to earnings. Our senior economists were just on CNBC right before I got on saying the Fed should aggressively cut rates. Partly, there's questions of the Fed independence, but our view that it actually could preserve independence by cutting rates because there is a risk of the recession. The recession risk has risen, and long-term inflation expectations have not. So our point is they should be cutting rates. The tariffs are a one-time impact, and they should take that precautionary measure. And this is sort of one thing where Siegel violently disagrees on tariffs and says Trump is definitely off his rocker there. But he agrees with him that Powell should be cutting rates now. That is one thing we are saying that actually Trump is right on, that they should be cutting rates and helping. He's going to become the scapegoat for even Trump's policies creating the uncertainty. Powell's going to become the scapegoat because he kept rates too high, is part of our worldview.
Well, I mean, Professor Siegel for a long time, obviously, we've heard, and obviously we hear him, on CNBC all the time, talking, about, how the Fed kind of messed up, with obviously keeping rates, too low for too long. But now he thinks they're doing the exact, wrong thing here, keeping rates up for too long. I mean, talking, just, what Powell was talking about last week, he did not sound dovish, like there was imminent rate cuts coming. I mean, what were your thoughts, just as you watch Powell? Obviously Trump is fully upset, trying to, rumors that he may even potentially try to get, fire Powell, which I don't even know if are in his powers to do that. But, thoughts here just on, Jay Powell's commentary last week and, potentially, with this Trump commentary of getting fired. So we'll start with the first part of the question. What'd you think of Powell's comments?
Yeah, he was definitely overly hawkish, is our view. And, it comes back to some of their abandoning of the money supply. Siegel is trained as a Milton Friedman money supply drives everything type phenomena. And, the money supply is growing less than 4%. You want the money supply growing 5.5% to 6%. That's consistent with 2 to 3% real growth in the economy, 2 to 3% inflation. We're not hitting those targets. Even if you have this tariffs as a one-off bump in inflation, it's not a long-term inflation. And when you look at the estimates of sort of 5-year inflation 5 years from today, it's not going up. It's actually going down. It's coming down. The longer-term inflation expectations are coming down. And so that's one of the reasons why we think you could be cutting. And so, that's our outlook there. Usually you should have the long-term, the 10-year, you're sort of at almost a flat, 440 on the 10-year, 430 on Fed funds. It's basically a completely flat yield curve. It should be 100 basis points positive slope. So the 10-year should be 100 basis points higher than Fed funds. And so this is where we think is a normal, healthy yield curve. It's not there, and they should be bringing things down. In May and June, continue getting it to that positive 100 basis point slope.
Let's just go and continue on here with Fed, but also with the second part of my question is, what did you think on Thursday when you're hearing the rumors that Trump's looking actively to try to replace Powell? Like, is that concerning to you? Is that, like, you guys, over obviously Professor Siegel has been saying, we want Powell to cut rates as well. What are your thoughts here, as Trump is now looks like taking another step into trying to get rate cuts by actually going maybe above his powers to try to replace Powell before his term is up?
Well, in some sense, it serves as this useful scapegoat for him. So which is another reason why Trump should just cut rates to not be the scapegoat. But in a way, you might say he might want that tension that he could talk about how he's doing a terrible job and just say it's all Powell's fault, not my policy problem. He should have lowered rates, and we're in a recession because he kept rates far too high. So the tension might actually be useful for Trump, and so he might talk about firing him and not actually take it up to the Supreme Court, because there will be an open question: can he actually fire him? There's these legal questions in the interpretation, like what is really allowed. So that could be a long battle, and so that'll be a question: does he go down that route? But the actual just leaving him in, threatening to fire, and talking about, hey, it's all his fault because he didn't cut rates, that's possible. So we'll see if the Fed's commentary can start turning a bit more dovish. They see the risk of the recession rising. The more they see evidence of that slowdown, they should start being a little bit more proactive here and trying to protect the economy from the recession.
Hey, Jeremy. Yeah, I mean, I think too the difference between Powell and I think it was Waller who came out, and Waller was more the sense of not saying that they're going to cut rates right away, but just that they're watching them and they're alert to them, and they're watching the data, right? And that's what we've heard before too, is that, hey, the Fed is data dependent, we're data dependent, and then all of a sudden it's kind of a shift to like, hey, we're going to kind of let and see how this works out. But I find that very interesting. I find the difference between what some of the Fed speakers like a Waller is saying versus Powell. I know WisdomTree does a lot of they have a lot of international ETFs.
Yeah.
That's been the hot story this year. Are you looking at anything in that area? Is anything kind of really coming to the forefront right now and saying, hey, this is something that's more of just a reversion to the mean, but you think that there could be some continuation of outperformance this year?
Well, I'll give you a few themes that we're talking about a lot. I mean, certainly you're seeing Europe come back to the leaderboard of leading the markets higher. I wouldn't say U.S. investors have globbed onto the Europe trade. I'd say broader national benchmarks are still seeing some of the flows. When I see the moves of the dollar, you're seeing a number of people commenting about how the dollar is disconnected from rates. For a long time, the dollar was moving with rates, and the last few weeks, it's really disconnected where the dollar's gone down and rates have gone up a little bit. So that could be, hey, flows are moving out of equities and global investors are going to Europe and to other places. They're going to gold. Gold's making new highs. In Europe, we have a global business today. In Europe, we launched one of maybe our most successful ETFs ever in terms of new flows. In terms of just 3 or 4 weeks, we launched a European defense fund focused only on European stocks in Europe. Took over $1 billion in a few weeks, and not like a single trade. It was like from a broad cross section of investors, and so that tells you one of the shifts. Partly that a lot of the European mandates focused on ESG and excluded defense companies, and now they're rushing to change the mentality. And I heard you talk about Lockheed Martin a little bit before as well, but the idea that Europe's going to have to step up defense spending on their defense companies has resonated, and even we filed for more of those for the U.S. And then
what's the ticker again for that one, Jeremy?
In Europe, it's a WDEF. It's a UCIT. So that's just
okay. Gotcha. It's a UCIT fund. Okay, understood.
But, we do plan to bring it to the U.S. later this year, and I think so that's one theme that's working long term. I do think I mentioned that who's going to be in front of the line for the trade deals. Japan was here; they came first. We have this view. I'm still. A lot of people were trying to trade China. I've been on with you, Dennis, a number of times saying I would not rush to chase China. Like I do not. I've been longer term. It's more of a challenge, and so I've been doing things ex-China. We do. Japan and India as our top 2 strategic allies, saying those are in our own model portfolios, we tend to overweight Japan and India, and we think they are our strategic allies in Asia, and we do think they will be making trade deals. And so I think that's our 2 preferences. Europe's been hot from this rotation and the defense and a lot of the challenges that they're going to do a lot more fiscal spending. And I think there's something to that. I think there's some interesting opportunities coming there. But long term, we tend to like Japan and India.
Jeremy, a lot of good practical thoughts here. Love the take here to get this week started. Thanks for joining us, Jeremy.
My
Have
pleasure.
a good rest of your week. All right, later.
Thanks, Jeremy.
Thanks, Jeremy.
Good stuff. Good stuff. Some nice practical commentary here.
This is EPI. I was looking at this over the last week or so. I've been looking at what India's been doing. It's not a bad place. I mean, in terms of the trend now, it's still below the 200-day moving average, and I like to see things above the 200-day moving average. But I like that it seems to be kind of bottoming out a little bit, and is at least got above its 50-day moving average. You got a little bit of a higher low from the last time, so I'm definitely kicking the tires. I don't own anything in India right now. The banks have been doing pretty decently there. So the financials, like if you look at like an IBN, which is an ADR that trades, but look at that. That's a new high. We don't have too many names that are making new highs. So, there's one of them, and it's an ADR. This is IBN is the ticker symbol.
I mean, this is a point we were making on the pre-market show over at the STN room, Christian, is just talking about, some of these ETFs and some of these, we were looking at Europe specifically, but I mean, the currency plays a role here as well. When you start bringing up certain ETFs, even like an INDA, obviously currency effects are in there. But, if we were looking, at EFA or VGK you were talking about, I mean, these ETFs over here are actually not that far from the highs. Now, a little bit of this is to do with currency, but we just had Jeremy talking, from WisdomTree, obviously on the international markets here. I mean, we're starting to see separation happening a little bit here, where international markets are starting to show some life, where U.S. markets are starting to not do that again. We saw this back in January and February, and then the tariffs hit in March, and everything collapsed together. But we're starting to go back into that trade where international stocks appear to be outperforming the U.S. stocks again. So, Christian's just on mute.
Oh,
sorry about that.
There
I'm
is.
looking
No
for.
problem.
I know that there's some comments coming from some Fed speakers. I think Goolsby's speaking somewhere. So speaking
Yeah.
of Fed independence, but he's mentioning that right now. But yeah, I mean, there was also brought up consumer staples versus consumer discretionary. I wanted to show you guys that chart as well. And there was a question in the
Okay.
chat earlier about where is what ETF is Tesla a part of? Tesla's a part of consumer discretionary, as is Amazon. Those are the two big weights that you have in the consumer discretionary ETF. And here's XLP versus XLY. It is not taken out the highs from the beginning of the month, but you could see that it has been trending up. You could look at as well. This is VGK versus SPY, which is Europe. Which is making a new high for the
Wow.
year. So that's VGK and SPY. Again, it helps to zoom out a little bit because I mentioned, and I asked Jeremy about kind of, is this still on terms of reversion to the mean? And, right now you're kind of testing this big downtrend that VGK versus SPY has been in. So again, it's important to zoom out because you go all the way back to 2008. That's a long time ago, but this is where SPY started to, 2009, SPY really started to outperform. So you're kind of button up against. So all of this price action has been this big outperformance that we've seen so far this year is just getting us back to like that 200-day moving average in the relationship. And the question is this trend going to change, or are we just getting back to a trend line where it could be rejected? So I think this is going to be very interesting to see how this plays out, because it's also, if you want to look at emerging markets, it's a similar situation.
Yeah.
Here's EEM versus SPY. And
Yeah.
EEM hasn't done as well. And I think part of that is because when you look at Europe, you have a lot of value stocks in there. You've got a lot of drug stocks. You got banking stocks. Emerging markets, you got a little bit more growth in there. And that's why if you look at this relationship going back, to 2015, 2016, yeah, you got a nice little move off the lows. But that's it. You don't have a trend change yet. So, so I think the bigger relationships are going to be interesting to watch as we get to, as we wrap up or get through some of the earnings season.
Yeah, just to mention, it is a pretty quiet econ week. We do have a couple Fed heads speaking. Goolsby is going to be speaking again on Wednesday. Waller also on Wednesday. But you guys had a couple of interesting rating changes here in the last 10 minutes of the show. Let's start with Disney. Disney upgraded to outperform at Wolf Research. Disney has been, a big talking point for you, Dennis. So I'll let you have the first comment here.
Yeah, I'm going to stick with this is like ground zero for tariffs. So if we get deals, if we get, potential, less tariffs, I think Disney really bounces from that. But I'm still in the camp that I believe international travel is going to be down, especially, with, just, thought processes that people are traveling, one, potentially to the U.S. less, but even U.S. travelers coming out and going to other countries. As you know, we get more and more of this tariff war going. People are buying more local and they're staying local. And, that's showing up, in the numbers that we're seeing. from, airlines, obviously, where international travel is down. I mean, international travel being down is probably the worst thing possible for Disney, because the one thing Disney, we've talked about this, is Disney's always had the parks going for them, despite their struggles, with ESPN, despite their struggles with Disney Plus, despite their struggles, with the movies, which, have been a disaster as well. The Snow White was not good at all. And I heard, more problems, over the weekend with another movie. They've had the parks going for them. That has really kept this stock, elevated and kept the earnings up. If for whatever reason, and the reason we're talking about is this international travel being down, the parks start to suffer, Disney doesn't have a lot of other stuff to lean on here. So I think there's a reason this stock is very near its lows. 80 is huge support. It goes back for years on this stock. So, I can get an understanding from a valuation perspective, maybe, but I'm actually taking the other side. I think there's a lot of trouble here for Disney with international travel being down. If it takes out that 80, I think you could see the stock at 70 in a hurry. So I would be a seller and fading this, upgrade here today, because I think international travel being down is really bad for Disney.
And just a little bit of color here to take the other side from that Wolf note, Dennis. They're saying that the Disney quote castle is still intact amid a risk of recession. The company has durable advantages in parks, cruises, and streaming. Kind of like the exact opposite of what you're saying, Dennis.
Yeah, well, that's it. That's what they've had going for them. But I mean, we can look at, American Airlines, and you can look at UAL, and you can look at Delta, and you can look at the cruise lines, and they've come down substantially because international travel numbers are coming down. I mean, that's Disney. That's been the good parts of Disney. So, I mean, Disney stock is down. It's priced in some of this for sure. And if we get a back off on tariffs, the stock can go up. So, I mean, this is just very tariff dependent is what I'm saying here. But I think the international travel is going to hit this stock, and I think it's going to catch some people because, again, we're in this market that really, I'm going to say it again, doesn't price in a hell of a lot. It starts to think about it, and yes, this starts to leak, but the market makes mistakes all over the place. Disney is an international stock, and yes, they have parks over in Europe, which can help to pick up the slack, but the two main parks are the California and the Florida parks, and the experience down there is unbelievable. I've obviously taken my kids there the last couple of years, but I'll tell you, there is a lot of people just talking, even from Canada here, that are saying, no, I'm not going to Disney this year. Like my kids are asking me, I don't know where we're going to be in December. So if I'm going or not yet, I do not know. Yeah. I love the US. I've always said, I'm not one of those elbows up. I want us to all be friends. That's what I want us to be, is everybody friends. But I mean, the international traveler spook. And you think about, I said it works two ways too. It's not only, that maybe travelers aren't going to be traveling into the United States. There could be, Americans that are saying, no, we're not going to be traveling over to Europe right now, for multiple reasons, saying, we're in a tariff war, we're going to support our own country as well. So I think the international travel numbers, just as this tariff war escalates and continues, I think those international traveler numbers continue to go down. So you got to be careful with those companies and stocks that really depend a lot on international travel.
Yeah, sure. And on that note, Dennis, again, the opposite of kind of where your head's at, we did see an upgrade on Norwegian Cruise, NCLH, Loop Capital to buy. You guys don't even have to like comment on that. But in that vein, Dennis, I did want to just mention that here real quick. Why don't we go to a couple closing thoughts here? We got a minute or two left of the show. Christian, do you have any closing thoughts to kind of set up the week as we're starting here on Monday?
Yeah, I mean, just kind of where we started. I think it's right now it's a very, very macro tape. I see gold right now is, as we've been talking about, gold is getting shinier. It's up now 3%. I'm interested in what Bitcoin is doing for the day. I mean, again, some of these things, it's just like I'm interested, like I'm watching because like Bitcoin is making a nice move. If Bitcoin can hold in here, let me just bring up the Bitcoin chart. Like that's something that I I'm kind of interested in. And here's where we are. I would like to see Bitcoin get over. This is Bitcoin futures, by the way, 88,270. So it's actually held up pretty well, Bitcoin. So I might be interested in a trade there as more of a little bit risk on. I've been very much in the risk off type camp. I've been trying to buy companies that are, even though like, and by the way, like this is great information today to talk about like how expensive Walmart is to Amazon, because it's tough to
Yeah.
buy some of these things here. But that's the camp that I've been looking at, like these little trends that have been holding up a little bit better. But I don't think you want to stay in that trade for now, especially if there's going to be, the possibility of some type of trade deal. So I would be, I'm trying to kick the tires about like putting on a position in case we get some type of positive headlines. So
I think you just got to be ready to strike, Christian. I think it's like we look at the headlines, and I know the market hates, a lot of people hate looking at headlines. There's literally traders out there that say technicals all that matters and headlines don't. We're just not in that market. So I think, to your point, Christian, I know you had some good trades and you do follow the headlines. And I remember, a couple of weeks ago, you having a good trade off Lululemon, because of positive. So I think you gotta stick to those headlines and just, be ready to strike, because if we get a potential deal, stocks like Disney and NCLH could, especially NCLH and the airlines, could rally the most.
All right, guys, we are going to wrap here. We're going to take it over to the STN room, stocktradernetwork.com. You can join us. We're going to have some programming here this morning. Christian, you'll be back for Christian's Corner at, what time is it, 2 p.m.?
2 o'clock. I'll see you guys at 2.
All right, everybody.
All right, take care, guys.
If you're not joining us on STN, we'll see you tomorrow for pre-market prep. Have a good day, folks. Good luck out there.